well, Happy New Year, everybody. Happy 2022. I know the holidays, I hope everyone had a wonderful holiday. I know us, we traveled back to Ohio, lots of quality time with family, probably ate too much, but I hope everyone had a wonderful holiday. So as we get into this new year, what Sean and I like to do, and we'll kind of walk you through, is how did the markets perform in 2021? Sean, the markets went gangbusters, right? The S&P closed at a record over 70 times. That's the most since 1995. So we'll kind of go through how the markets performed. We'll break it down by asset class, and then we'll also kind of talk about some of those headlines that you've heard and seen throughout the year. Whatever you want to call it, Omicron, Delta, coronavirus. Let's talk about what we've kind of learned this past year and how that impacts the markets. We'll talk about meme stocks. I don't know about you, Sean, but over the holiday at the dinner table, people were talking about GameStop, and when to get in, when to get out. And to tell you the truth, the numbers don't lie. So we're going to walk you through that as well. And then we'll kind of wrap it up in this presentation on what have we learned and what investors can do going into this new year, going into 2022. Most importantly, as you start the new year, you have resolutions, goals, hopefully some financial goals, things change in your life. What can you do to prepare for those? So we'll go through those as well. So Sean, without wasting any more time, I'll let you kick it off.
Awesome. Thanks, Nora. Yeah, so we are going to start with kind of how the markets did, right? So first off, we're going to look at the S&P 500. And if you've been listening to our monthly market insights, I like to use the S&P 500 as a good indicator of how the global U.S. markets are doing. I don't know if global U.S. makes sense. U.S. markets are doing, right? Because this is going to give us the Fortune 500 companies of America. Makes up about 80% of the total U.S. market. So it gives us a good pulse on the market. We prefer using this rather than the Dow Jones Industrial Average, right? So how the markets did, right? So the S&P for the year was up about 27%. And I like to point that out because I want everyone to reflect on all of the crazy headlines that came out throughout the 2021 year. The Delta variant, the Omicron, the Fed stimulus. You pick the flavor of the media's sources of craziness, and this is what we end up seeing, right? And so when we get to this point, we also went through an election, and we saw the markets do really, really well. So throughout all of those headlines, right, you can see the ups and the downs. We went through an September, October time period where the markets were down. Everyone got scared again, and bam, they came roaring back again. So the people that stayed patient were able to be rewarded. So it's just a good insight, and something we want you to know is how the U.S. markets did for the year, up over 27% in the year of 2021. Now, that's pretty amazing because the average of the last 3 years has been up over 20%. That's pretty amazing. As Nora mentioned, up over 70 times that we set a record in the S&P 500 in 2021. So we've got 3 years of over 20% annual gains in the S&P 500. And so we're going to talk about, right, what people tend to do when those things happen and how you can kind of prepare yourself maybe not to do those things. We're also talking about some other asset classes, right? So how the general market did as an overview, right? The best performing asset class in 2021 was real estate. Anyone that went through trying to buy or sell a home knows how crazy the real estate market was. Real estate as an asset class was up over 40%. And again, this kind of makes sense coming out of 2020. We saw a time period where everyone thought, I'm never going back to work again. My office building is going to go under. And we just saw that that's just not how things played out, right? A lot of that is because we believe that whatever happened to us really recently is going to continue to happen in the future. So people sold a whole bunch of real estate. And as it's come back really strongly, people started buying. The other thing that real estate is, it's a great inflationary hedge. And we saw the highest rate of inflation in the last 50 years. So real estate does well when inflationary periods are around. And so that's one of the reasons we saw real estate be the best performing asset class year to date. We also saw, again, you'll see the S&P 500. That's up over 27%. U.S. small value, think of your smaller banks or your smaller stores, your Hobby Lobby compared to your Home Depot, something like that. Those companies also did extremely well. The NASDAQ underperformed the S&P 500 for the first time in a while. And then kind of some of the other things that we see kind of towards the left of the graph there is that foreign large blend and the foreign small blend. So those are the kind of the international companies International still did really well, right? They had an 8% year, but normally we'd say that's I'd love to have an 8% return in a given year. But when we see other asset classes performing really well, we tend to say, man, those aren't doing so well. So we'll talk about some strategies there. The other thing that you're going to see is the negative parts, right? So we see bonds are down, negative bond return throughout the year. And again, one of the reasons that happens is because historically the data shows us, the evidence shows us that stocks and bonds are going to be inversely correlated. So when stocks go up, bonds tend to go down, bonds go up, stocks go down. The reason is because bonds are considered safe. So people sell their safe assets and they go to something risky, they go to stocks as the stocks are going up. So we see bonds decrease while stocks go up because people are pouring their money into stocks when we have a really good year. So that's kind of why we see kind of some of those negative returns in bonds. And we're okay with that, right? We input bonds into a portfolio so that we mitigate risk. We lower the amount of risk in the portfolio. It also lowers the amount of return long-term, but it's going to help you stay invested during really volatile times, which we've really been through in 2021. All right, so we saw emerging markets also having an under 5% return, about almost a 1.5%, 2% return. That's your China's, your India's, kind of your South American countries. And if you were paying attention to some of the headlines in 2021, we saw the Chinese government go after some of the Chinese corporations, go after some of those companies, especially their largest real estate holding. And so when we see those things, we're going to see a negative impact in those emerging markets, right? So that kind of explains and kind of give you a little background on really how all the asset classes did in 2021. Again, kind of the key points, real estate being the best performer, US markets did really well. International markets did just fine, just not gangbusters like the US market. And then bonds were down this year because people sold their safe assets coming out of 2020, and they put them into more risky asset stocks as they were rising. Okay, so that's going to give you a good overview. Now, what we tend to hear and the questions we get from people is, why am I even in bonds then? Why do I even own international? Why don't I just put all my money in real estate? That seems to be doing really well. And the same would be true for any of these meme stocks that we'll talk about here, right? The Bitcoins, all that. We think that whatever's happening today is going to continue in the future, right? So this is what we call recency bias. This is a behavioral finance topic. It's talked about all the top MBA programs around the nation. But we think that we tend to put too much emphasis on things that happened really recently to us. So we tend to say, you know what, I don't need international anymore. Let me go all to the US. You know what, maybe it makes sense to put some money into GameStop or Reddit or AMC or Bitcoin or whatever it may be, because those did really, really well. We want you to understand that with more risk can come more return, but also more risk can also equal a much greater loss. So we're starting to see those things happen as well. So don't think that just because the US market's been up over 20% the last 3 years, that I should follow my money there. Because in 2018, we saw the US market be down about 18%, losing almost all of that in the fourth quarter of 2018, as we saw the Fed tries to raise the interest rates, and then Trump and China got into that little trade war. So the market's reacted negative. So we had a negative 2018, 3 phenomenal years following that. Again, that kind of explains a little bit about why we see some workforce numbers declining. Is because people's 401ks, their retirement accounts are doing really well, and they may say, you know what, I don't think that I want to go back to the office. Maybe I'll retire early. So we're seeing more and more people retire early. We're also, with COVID, we're seeing a lot of people inherit money, pass away, and start to kind of put that game plan in place. And so when those things happen, you have an inheritance, your 401k balances are high, people leave the workforce. We'll see how those things kind of play out. But what we want to talk about here is, how can I protect myself against recency biases? Let's look at evidence, which we're going to do today, about why you should stay diversified and not go chasing risk. Because we saw this in 1999 with the tech bubble bursting, right? Everyone saw tech bubbles going, their tech stocks going really high. They poured all their money in there. And then 2000, 2001, markets came crashing down and people lost a fortune. So we don't want you to think that just because things are going really well today, that's how they're going to play out in the future. So we want to make sure you're making long-term decisions, not deviate your financial plan, understanding the evidence behind it. Right? So that's what we want to do today, is kind of educate you about those things. So let's talk about some of the fun things, right? Some of the things that happen probably around your Christmas table or your New Year's Eve celebration, right? So kind of the Mega Millions, $500 million Powerball out there right now. I wouldn't be mad if you throw $2 in there, right? You throw $20,000 in there, I'd probably be a little upset with you, right? But we see these things all the time. And really it comes down to the way that we want to start the new year as well, right? So we see all the people kind of sign up for their gym memberships. Everyone wants to lose weight really quickly, kind of sign up that diet pill, because understanding how to lose weight over the long period, the entire year, is really, really hard. So we want to lose that weight really quickly. Well, the same is true with our finances, right? We want to win quick. No one wants to sit there and take the slow approach to getting rich. They want to get rich now. So we saw some of these stocks, some of the news headlines, people on Reddit, market manipulators boosting up certain stocks. Lost my slide there. And let's talk about some of the performance, right? So Reddit there in May, you kind of see the percent gain on the left. I mean, there's some pretty amazing returns, right? And they're starting to come down as people come back to reality. But kind of some of the meme stocks that we saw and how they performed in 2021, it's always very interesting to take a look at. But you can kind of see some of the early ones, right? The costs and the GameStop. All those companies did really well early in the year and then came crashing down. So with big risk comes great return, but also comes great losses. So we want you to be careful because you never know when you're getting in, right? And this kind of goes back to the real estate discussion as well. People are like, should I put more money in real estate today, Sean? I said, you should put more money in real estate in March of 2020, right? That's when it made most sense, but no one has that insight because it's really scary to invest in real estate at that time, right? So we don't want to jump in while everything's doing really, really well. We want to make sure that we stay patient and we have a disciplined approach to the whole process. So how does that play out for US markets if we're just talking these international companies? So one of the things we want to look at is we got the US large cap growth, right? Kind of representing the Fortune 500 there in the blue, the S&P 500. We've got international developed companies, these larger companies, your Volkswagens, kind of the larger international companies. And we have those emerging markets. If we look from 2009 all the way through 2021, everyone would say, let me pour all my money into the US market, right? It has gotten an 18% return while the other asset classes have only gotten an 8% return. So that would be, hey, let me sell out of international, put all my money in the US. What we want to do, again, is talk about that recency bias and why not to do so, right? Why having a disciplined approach is great because no one knows what the best performing asset class is going to be moving forward. But certainly also another great slide for just kind of how the markets have been doing. They've really been going gangbusters over the last 10 years. But if we take a look and see what happened from 1999 through 2009, the previous decade, you can see that that same asset class, US large cap, S&P 500, was actually negative, right? We call it the dead decade, a flat return over those 10 years, while our emerging markets is up over 13%. So had you said, hey, let me put all my money into emerging markets back in 2009, you'd have missed out on that great return. And if you put all your money in US, you may be missing out on just the opposite. Now, we're not here to say that's true. There's no way for us to know that. We don't want to try and predict the future, but we want you to be wary to say, you know what, I don't want to go chasing returns just because they're there. We have no idea what's going to happen moving forward. Because what's really interesting is when we take a look at this, and this is what the data are going to show, is that over the long term, they're all going to end up about the same. So we look at this from 1999 through 2021, even though the US has gone absolutely gangbusters the last 3 years, right? It tends to end up getting about the same amount of return as the emerging markets during that same time period. And international just lagged a little bit, right? And if you take out the last 3 years, international and US did the same. So we don't want you to go chasing certain asset classes, say chasing certain investments, just because it's doing really well recently. Right? Very, very eye-opening to kind of look at the data long-term. Don't go chasing returns. I felt like TLC right there. Right, so how do we do this? How do we avoid this? We invest evidence. We listen to some research from Nobel laureates. They've gone out and found out exactly how to do so, right? And we want to make sure we take a long-term approach to this. Kind of showed this slide last time. Jeff Bezos asked Warren Buffett, if his way of investing is so simple, why doesn't everyone copy you? It's because no one wants to get rich slowly. The same is true with dieting, right? The same is true with anything. To have that long-term approach, it's much easier to have a very simple approach to it and stay disciplined throughout the process. If not, you're gonna have to get right consistently. You have to guess right consistently, and no one can able to do that, right? The data is very clear. So have a disciplined approach, take the process slowly, and what ends up happening for you is if we go back and look at kind of our portfolios a lot over the last 10 years, we wanna point out some unique things here. So in black there, you'll see cash. That's representing a money market account or a savings account earning about 1%. So you put in 100 grand about 10 years ago, that 100 grand at 1% is worth about 111,000. Inflation, right, being at 6.8% over the last year, We look at inflation over the last decade, you'd have lost $14,000 just having money sitting in a savings account or 1% money market account, losing out to inflation. So oftentimes people think, I've got my money in cash, it's in my savings account, it's very safe. And I tell people it's actually the riskiest place you can put money. As a financial advisor, if I told you I could lose you 5% per year over the next 10 years, you would never give me a nickel of your money. But that's exactly what you're doing when you put money into a savings account, right? You have no idea how inflation is going to be. You're guaranteeing yourself a loss. So what we typically recommend is put people in a conservative brokerage account. You'll see the brokerage account outpaces inflation, outpaces the savings account. Again, a disciplined strategy, still very liquid. And then for long-term money, depends on how much risk you want to take, right? You have our moderate portfolio, growth portfolio, and aggressive portfolio over the last 10 years. Again, having all that diversification there, not chasing returns, not chasing certain asset classes during high periods of return. Want to make sure you have that disciplined approach to it because, again, just like Warren Buffett said, you're going to get rich slowly. It's going to be a very disciplined approach, but you're going to earn money just as you should. How our portfolios did for the year: conservatives up about 5.5%, moderates up about 10.5%, growth up almost 15%, and aggressive up over 20%. With all of that kind of diversification in there. So that's a good kind of recap of the markets, kind of how things did, what asset classes did really well, and some ways that you can protect yourself against some of the recency biases that are out there, some of the meme stocks and things that you can be careful of, knowing kind of what some of the evidence shows over the last 20 years, rather than focusing on what's just happening right in front of me right now. So with that being said, we're going to open up some questions and we'll go from there.
Yeah, Sean, one of the questions that came in was regarding the stimulus package. I know late this past in 2021 Q4, a lot of laws passed and changed. Can you talk to us about how that may impact what 2022 brings in terms of the stimulus package, cutting back, what the Fed's doing in regards to inflation and trying to level that off a little bit?
Yeah, so really kind of some of the things that we're really monitoring in 2022, and I think we'll explain how the markets perform in 2022. Right, first off is exactly what we talked about, the stimulus packages, right? So we're printing a lot of money, we're spending a lot of money. All of those things lead to consumer spending, right? Because now we've got to go out, we need to build supplies, businesses do really well, they need great concrete, rebar, all those things to kind of develop some of this infrastructure. And so those tend to lead to consumer spending, and anytime consumers spend, the markets do really well. 2/3 of the U.S. market's made up of consumer spending. So that's what we saw in 2021. You saw dumpsters in people's driveway, people redoing their patios, redoing their houses. All of that spending leads to markets doing really well. So stimulus will be good for spending. Stimulus will be bad for inflation, right? So again, the highest rate of inflation in the last 50 years. The Fed's target rate for inflation is typically 2%. They want the average to be 2%. We saw 6.81% in 2021. So they are more than 300% higher than what their target rate is. So ways that they're going to combat this and things that we're going to be watching. The Fed has already talked about they're going to start to raise interest rates and pullbacks in their bond purchasing program, which would lower the amount of supply of dollars in the economy. What we're going to see as the Fed tries to raise the interest rate is how the markets respond to that. Typically, growth companies don't do as well. Growth companies could be your tech stocks, right? These companies have been able to go out and borrow money at 2 or 3% and go get a return of 20%. So it's been really, really appealing to them. Well, as the Fed raises the interest rates, they're going to have to pay more to borrow money, and it will typically slow down their growth. So that's something that we're monitoring. Does that happen? How quickly does the Fed raise the interest rate, and how do the markets respond? Because like I talked about, we saw in 2018 that fourth quarter, the Fed tries to raise the interest rates, and the market did not like it. Right? We had a mini recession where the S&P lost almost 18% in one quarter as that happened. Now, that was also in combination with the China-Trump trade war. So we don't know how that will play out, but something that we're monitoring. How does inflation respond? Do we continue to see high rates of inflation? Does it continue to grow? How aggressively will the Fed raise the interest rate, and how do the markets respond to that? We typically see during high periods of inflation is a couple good asset classes of real estate and commodities. So we've seen oil do really well. We've seen real estate do really, really well. That's a good inflationary hedge. Also, we might start to see some of those international companies do really well. Does all of this stimulus weaken the US dollar? Because when the US dollar weakens, we tend to see international goods do really well. So that's kind of what the things that we're monitoring over 2022 is Fed raising interest rates, the stimulus being put in the economy, which would impact inflation, and how do kind of some of the international markets change as we watch the dollar strengthen or weaken over the course of 2022. And then always, right, we've got coronavirus always looming. I think what the markets have essentially said is you're not going to shut down the economy anymore. We've been through Delta, we've been through Omicron, we've been through the original, coronavirus. We kind of know what works, we know who's affected, so we're not going to go ahead and get too worried about it. So I think the markets are kind of, despite what the media wants to say, I think the markets are over coronavirus for the most part. But again, if more and more data comes out, it could impact the market through 2022 as well.
Thanks, Sean. And another question, or a couple of questions actually, regarding to taxes. So I know we're starting to plan for wrapping up our 2021 taxes come April, but things that may be changing, strategies we can in terms of, your income level or Roth contributions, what things are changing, what strategies can we start thinking about now as we start to plan for next year's taxes?
Yeah, so Roth IRAs and IRAs, right? The balances, the contributions remain the same, $6,000 in 2021, $6,000 in 2022, and they each have that $1,000 catch-up contribution. So no changes for IRAs in that regard. Roth for 401ks, the contribution went from $19,500 up to $20,500. So make sure you're updating your employer contributions through your 401k to make sure you're maxing out that $20,500. And the kind of the same catch-up contribution remains the same, so $6,500. So you could essentially put in up to $27,000 into your 401k. And kind of no really changes in terms of Roth traditional. One of the things that's happening, still going through legislation, but do they eliminate that backdoor Roth conversion? So something that we do for clients that make over $210,000 combined is we put money into a traditional IRA, and the next day we move it into a Roth IRA. It's called a backdoor Roth IRA. That's going through Congress. It's a way to kind of tax the wealthy, eliminate that loophole, but it has not happened yet. So we did a lot of it, right? So that's one thing that we want to do for clients, and we'll continue to do through 2021 and 2022. Is put as much money as possible into the Roth IRA, Roth 401k, because those accounts are going to grow tax-free. And I don't know about you, but I think printing money and increasing stimulus is going to lead to higher tax rates in the future. So we'd rather pay taxes today and eliminate some of the future tax increases that I anticipate in the future.
All right, that looks like all the questions I see. If you guys have questions, even as we go throughout the year, continue to do these monthly market insights at the first Monday of every month. Send those to Sean and I. For clients that are on the call, if you're looking at 2022 and there's been a change to your life, a circumstance, meet with us. We'll update that financial plan, make sure you have a good strategy in place. Again, as you continue to have questions, send those to us. We're always here as a resource. So with that, I wish everybody a happy new year as we get into 2022. If last year didn't go as well, I hope this year is better. And if last year, like the markets, went great, I hope that this is even a better year for you. So with that, we will meet in February, the first Monday. Again, send questions and have a good start to the year.
Thanks, everybody. Happy New Year.